Hello, this presentation is for the summer course DSA 5303. It is an introduction to algorithm trading. Basically, this presentation is an overview or a survey of algorithm trading in the marketplace. What we will discuss during this presentation is the emergence of algorithm trading in high-frequency trading, the architecture of algorithm trading systems, trading strategies, including the use of statistics, machine learning that's sometimes used in algorithm trading, the role of text mining, optimization techniques, impact analysis, as well as regulatory issues. So electronic trading is the use of computers to send and receive financial orders. This basically is what it says. It's just electronic trading. It displaced previous methods that were used to place orders by phone or people in person. Who used to see those people in on videos at the stock market and NASDAQ or the New York Stock Exchange, all going frantically there. But by and large, that's been displaced by the use of electronic trading. Algorithm trading is a subset of that. It is beyond just electronic trading. It is using computer programs to make the decisions that humans would make in order to process or issue buy or sell orders. So characteristics of algorithm trading. It is a subset of electronic trading, like I mentioned before. What it does, it takes advantage of electronic decision-making, which is obviously way faster and way more accurate than the decision-making process that a human would follow. Uses trading criteria, using price, quantity, math models, government financial data, proprietary economic data, and in instances it facilitates market liquidity. Not always, but generally it facilitates market liquidity, due to the speed and volume of the transactions. Some of the benefits of algorithm trading are, trades can be, executed at closer to optimal prices. The algorithms, are more precise than humans. They can pull the trigger right at the exact time without delay. You have increased accuracy and timeliness of orders, again, taking out the human factor, and, the orders are issued near instantaneously. You have a lower transaction cost due to a lot of the elimination of the human factor. In my line of business, humans are pretty much the most, costly component to any solution, so this is a reduction of that component. It provides automated checks on multiple market conditions, reduces human error. You have the ability to test it on historical real-time data to see if it's profitable, if it's working, and you also are able to eliminate errors, due to the emotion of traders. If some news comes through the wire, you may have a trader that makes a buy or a sell decision based on emotion rather than economic facts. So again, high-frequency trading, as we mentioned before, is a type of algorithm trading. It's high quantities, small orders that are issued to financial markets. Basically, high-frequency traders use programs that quickly analyze large amounts of data. It takes advantage of pricing inequalities. A lot of times in different marketplaces, the same financial product could be priced differently. It takes advantage of that. Another characteristic of it is the positions are not held for very long. And finally, most of the algorithm trading is high-frequency trading as well. The architecture of an algorithm trading system, you typically will find basically a training strategy container that does all the training and tuning based on historical data. You do a lot of your work on your algorithm in this space, using historical financial data to tune it correctly. There's also a training container on real-time data, where once you've got your algorithm, in good shape, working on historical data, you may place it here and operate it on real-time data. And once you are confident that your algorithm is running properly, you would move it forward into production. Some of the processing requirements you find, again, looking at a modifiable pre-processing environment, distributed processing, individual process units, uses a storage area network, make sure it incorporates disaster recovery, as well as an order management system, and then a system usage environment. One of the most important elements of an algorithm trading platform is backtesting, and that is the process of using the historical data to test the algorithm. Some of the key concepts of backtesting is to make sure that you use data from the market in which you're going to be trading in. Will only make it more effective. Make sure that you use data from a sufficient time period, and basically also evaluate some of the metrics that are listed on the screen here. Listed on this slide are a number of the trading strategies. Head and shoulders is a pretty simple one. If you think of a graph with peaks and valleys, basically known as head and shoulders, a lot of financial instruments trade in this pattern, and you might have an algorithm that identifies that pattern and also identifies the proper time to trade in and out of a financial instrument. Trend following strategies, basically what it says, follows different financial trends, and again makes it a trading decision based on what it finds there. Arbitrage opportunity, alluded to that before. You might have a stock that's listed on multiple stock exchanges. There might be a small price difference of the two based on foreign exchange, whatever, and there may be an opportunity for the algorithm to buy and sell in order to make a small profit. Index fund rebalancing. There are periods of time where where mutual funds or index funds end up getting rebalanced, and there are algorithms out there that wait for that to happen, and make buying decisions based on that. Again, you'll see here on the screen, there really is a lot of different strategies. One of the more interesting one is there are algorithms out there that actually detect other algorithms that are in place and try to determine how it is that they're operating, and basically attempt to exploit another algorithmic trader that's out there. Use of statistics. The algorithm traders use, unsurprisingly, a lot of technical analysis when making the trade decisions. They'll use time series modeling. The statistical modeling can help you reduce the drawdowns and filter out, really, here's the important part, on high probability trades. And also the statistics are used for entry and exit points, when to enter and when to exit the marketplace. As we've seen in some of the other projects for this class, some of them have used machine learning, machine learning algorithms, but this is very common in the algorithm, trading area. What was interesting here is this Professor Gordon Ritter. He did demonstrate that it was possible to use machine learning in order to identify profitable opportunities in the marketplace. So what he did was he provided a data set that embedded in the data set were arbitrage opportunities, and they used a variety of machine learning algorithms, and the Q-learning algorithm was able to identify and exploit the arbitrage opportunity that was in the data set, and it was through that he was able to demonstrate that you could use machine learning for algorithm trading. And then basically, machine learning comes in two varieties: supervised and unsupervised. Supervised learning, where you have input variables X and an output variable Y, and you use an algorithm with a mapping function basically to map the input variable to the output variable. Unsupervised learning is where you only have the input data and no other corresponding output variables. And basically the goal of that, again, as you see, is to model the underlying data in order to come up with an approximate model. Text mining is also used in algorithm trading. It's basically using software to extract, insights from, a variety of sources. Could be like, a press feed, a wire feed, could be Twitter, could be any number of things. But basically, it analyzes the data in patterns and basically try to identify insights that can be exploited by algorithm traders. A subset of this is sentiment analysis, which is basically when, you basically will try to find the feeling or the sentiment behind the text. If you think of, on Twitter, if like, a product or an artist or something is trending positively or negatively, it may, may impact something that a company is selling and therefore the price of their stock, and that is something else that is used by algorithm traders in order to make their buying and selling decisions. There are a number of optimization techniques. I mean, basically optimization is taking the parameters that you're using in your model and basically training them to try and identify their best values in order to get your algorithm running as best as possible. There are many types of optimization techniques. There's two types that we're going to discuss here. One is batch optimization. It's where you work on a historical data set for basically optimizing your parameters. You just look at historical data. One of the issues, or there's a few issues with that. One of them is that the historical data may not be representative of what the future is. The future may not repeat the past. So while you may be, have your algorithm trained very well on the historical data set, that does not mean it's going to work well on real-time data or work well tomorrow. Another thing is there might be noise that's embedded in the data set that you're unaware of, and you may end up training your algorithm, with that noise as well. And again, that would also affect your algorithm as it worked on real-time data. There is a way to alleviate this working in walk-forward optimization. This working in batch optimization, and that is called walk-forward optimization. That's when you take a smaller historical window. Instead of working with a year or two worth of data, maybe you work with a week or a couple days worth of data, and you walk backwards, a couple days or a week or whatever that smaller set is, and then you basically work in real time, walking forward, correspondingly, whatever your unit is, be it days, a week, what have you, and optimize your algorithm that way. That way you are kind of training it on some historical data, but also real-time data as well. Tends to be a little bit better than using the batch optimization. Impact analysis that has had an impact on the financial market in a number of ways. Basically, speed of trades gets faster and faster. As our networks get faster, processors get faster, the speed of trade gets faster. As you would imagine, the time windows for executing a trade get smaller and smaller. The trading volume is doubled. Honestly, I forget the point of time when it's doubled, but really the point here is that it's basically ever increasing, right? The ratio of electronically traded and algorithmically traded assets is only increasing. It's definitely not decreasing. Downside is you can have market crashes based on algorithmic trading if there's not a safety valve put in. But if you were to have a metric mover higher, above or below a threshold, you could have, and these have happened, you could have a mass sell-off, and what ends up happening is you have no buyers in the market, and then you end up having a flash crash. And again, that's happened more than a few times, in history. It doesn't, conclusively increase liquidity, but there have been, been times when it decreases it during market crashes. When you have buyers leaving the market, basically you have liquidity reduced, and this happened in in 2015. I remember this on the news, this flash crash with the Swiss franc, and it happened real quick, and then some companies did end up going out of business over this. You also have a smaller bid-ask spread, the difference between the price at which somebody's willing to buy and sell something, and also through this, you've basically made it easier for traders to take advantage of inefficiencies in the marketplace. So as far as regulatory issues, there is very little regulation that's specifically focused on algorithm trading. There have been some complaints. I don't necessarily think that this is a big issue personally, but some people have taken issue with organizations that are co-locating their assets very close to the market with which they're working in, and the closer you are to that, the lower the latency, the quicker you can execute your trades. But there have been some issues. There's some complaints about that. There's also been some issues where these traders, electronic traders, are really only interested in arbitrage, just looking to make a little bit of profit, not really bringing any value to the investor, to the marketplace. That has been a common complaint. And I think this is a little bit more of consequence, is that it does provide people with the ability to manipulate the markets. There was a firm, Athena Capital Research, that figured out that they could inject trades into the very last bit of the trading day, and they would do it whichever direction they needed to do it in order to make sure that their earlier trades during the day were profitable. And you can see they would basically issue last-minute orders that would cause a disruption in the marketplace, and it would basically allow them to profit off the trades. Truthfully, the profit wasn't all that much either, but this was the first incident of a high-frequency or algorithm trader that had to have a settlement with the SEC. That is basically the conclusion of the presentation, and again, it was an overview of algorithmic trading. Thanks, and I'll talk to you later.